Good afternoon, everybody. There isn't any need for a roll call. The staff's going to mark everyone in attendance. It could take a little bit. I'm Michigan State Senator Lana Tice. I'll be chairing the meeting today. I'm first going to entertain a motion to waive the quorum requirement, which I think we might need. Moved and seconded. All in favor? Aye. Now I'll entertain a motion to approve the November 24th, 2024 meeting minutes. Motion, do we have a second? Second. All in favor? The motion is approved. Thank you. We're going to start today with a presentation on developments in flood insurance and state resiliency initiatives. With us here today is Dana Sutton of NFP and Eric Fosmeyer of South Carolina Office of Resilience. We'll hold questions until they're finished. Dana, would you please go ahead with your presentation?
Yeah, hi, thank you. Good afternoon. My name's Dana Sutton. I'm with NFP Property and Casualty. I'm my company's flood practice lead. So all our flood insurance that we write within my agency flows through me. And I'm very immersed in this space and interested in improving outcomes for folks post-catastrophe. I wanted to start today with this statistic. This came out of Aon's Climate and Catastrophe Insight Report for 2024. This is a report they put out every year based on the previous year's loss data and statistics. And the report found that in 2024, the flood protection gap was approximately 75%, denoting that flood remains an underinsured peril as many property owners lack adequate insurance coverage. Despite the availability of flood insurance policies, there can often be a lack of awareness and understanding of the risk. And this is really the sort of thesis of kind of what I wanted to get at today, and sort of the crux of really my career here. It's this notion that we are missing the mark by 75% when it comes to insuring for flood losses. This is just a graph that also came out of that, or a chart came out of that report, illustrating this was economic losses on a global perspective. And you can see that both Helene and Milton were number 1 and number 2 for 2024 in terms of global losses, which is pretty significant. Hurricane Helene became the costliest event of the year, obviously, estimated $75 billion in total direct property damage. That doesn't even account for soft losses and sort of those intangible economic losses. That's probably an outdated number by this point. I suspect by now it's probably higher, but this was in early January when this information was available. Impacted Florida, as you know, but really that wasn't even the headline that came out of the storm. The headline was really what happened in Western North Carolina with those folks out that way. Apologies that this one's kind of small. These two graphs are cumulative global economic losses broken down by peril. So that first graph on the left is economic losses in the billions. And if you can see, the peril of flood is that second line down from the top, that blue line. So pretty significant in terms of $1 billion of losses for flooding specifically. And then that graph on the right, that is the count of billion-dollar flooding events since 2000. Again, it's that blue line, kind of crisscrosses at the very top there with the green line. So really significant steep rise in billion-dollar flooding events since 2000. Actually, I wanted to go back to this and just mention that the flood insurance policies have a 4% uptake rate. And that's our issue. That's our problem with flood insurance. For every 100 properties I quote, I will write 4 of them. So really, you might question the wisdom of someone doubling down in a space where you miss 96% of the time, but really an opportunity here to improve outcomes for folks. So I guess the question then becomes why? Why is that we have this 75% protection gap and only a 4% uptake rate? And I really think a lot of that has to do with some of the unintended consequences of the National Flood Insurance Program. I'm sure all of you all know, the program was implemented in the 60s and was really a response to the insurance industry saying, look, we don't know how to underwrite for this peril of flood, so we're just going to exclude it. And the federal government really wanted to continue the growth and development of these coastal areas, so they implemented the National Flood Insurance Program. They used flood zones as the rating methodology to rate and assess for risk. And cut to decades later, what that's really created is this belief in people's mind that you are either in a flood zone or you're not, and you either have a risk or you don't. And what we're finding, according to the North Carolina Center for Geospatial Analytics Department, that in fact 84.5% of flood losses are occurring outside the special flood hazard area or outside the so-called flood zone. So while there is this belief that I'm not in a flood zone, in reality 84.5% of the losses are occurring where people believe they have no exposure. 51% of the population is 2 times more likely to have a 1 in 100 year flooding event than the current maps indicate. That's according to the First Street Foundation. And over 8 million properties outside of the special flood hazard area are at a risk for flooding from rain, which is largely unaccounted for when we talk about flood zones. There's also very much this belief among policyholders that if your lender is not requiring you to purchase a flood policy, that you don't have a risk. So a lot of these subsequent federal lending regulations surrounding the mandatory purchase of flood have really led people to believe, oh, my lender doesn't require it, I don't need it. And that's a massive hurdle for me as an insurance agent. I wanted to include a copy of this letter that one of my insureds received just this past January. This is a client I've written their insurance for more than 10 years. I'm very, very familiar with this account. Certainly consider myself their trusted advisor. They owned a home that was located in a special flood hazard area and had carried a flood policy on it. In December of last year, they were remapped into a preferred flood zone, which triggered this letter from their lending institution that says flood insurance is no longer required for your loan. Then goes on to say, you're going to be responsible for paying the premiums. If we purchase the policy for you, we're going to cancel it. And if we had it paid from your escrow, we're going to quit doing that, and you are now going to be responsible for making those premium payments. This insured of mine very much took this letter as a message that they did not need the flood insurance. This home's worth about $1.5 million, literally sitting in a swamp. They have tidal water on 3 sides of them and a pond behind them. And their flood insurance premium was $800 a year. Like I said, I'm very familiar with this account. The $800 a year was not preventing anybody from going to the dentist or sending their children to school or even dinner out. And no amount of explaining to the insured their actual exposure was enough for me to overcome this, and they canceled their flood policy. So that's a really tough conversation to be having. I don't have an insured that I felt more strongly should be keeping their policy than this account, and I still could not convince them to do so. They also had, incidentally, about $1,200 worth of risk rating 2.0 credit on their policy that they also forego. So by canceling the policy, they wouldn't be able to get that credit back. And if they needed to go back into the federal flood program at any time, they'd be going back in at the full risk rate. Another one of those unintended consequences of the NFIP is a belief that FEMA will step in and pay for losses, which probably blows everybody's mind sitting in this room right now. But I can tell you, as someone who considers myself sort of on the front lines of this, this is very much how people believe. I have an agent, actually, a licensed insurance agent out of my Bluffton, South Carolina office that did not bother selling flood insurance to any of her clients because she thought FEMA would step in and pay the losses. So that's really, again, a tough narrative to overcome when even a licensed professional is under that impression. It's tough to convince the general public otherwise. There's a belief that coverage is included on your homeowner's policy. I think that's on us as agents for not adequately explaining that exclusion to people, but still very much a strongly held belief. Again, a misunderstanding of the definition of flood, another problem we have, specifically what we mean when we are talking about flood insurance. There's a misunderstanding of what constitutes an adequate limit. So in the rare occasion when I am able to convince my insured that they should carry a flood policy, more often than not, the limit they are selecting is $250,000 on the dwelling and $100,000 in contents. Doesn't matter if it's a $20 million home or a $250,000 home, that tends to be what people are opting for. And I very much believe that's sort of a byproduct of that being the maximum limit that you can purchase within the NFIP. $250,000 might have been enough back in the 60s, but certainly under today's costs, that doesn't even come close for most folks. And then finally, there's really been a lack of confidence within the private flood market due to the federal government's financial strength and stability. The fact that people feel really strongly that the program's not ever going to go anywhere, and that they will not default or go insolvent or be unable to pay somebody's claim. So people are very, very hesitant to explore options within the private market because by comparison, anything in the private market seems like a more risky option for people. So despite all these challenges, and maybe the most frustrating thing for me is we do have a solution ready to go for most folks. For the overwhelming majority of people, the private market is a really, really great option, and there is a ton we can do within the private market space. It's growing rapidly. The surplus lines market has over $1 billion in flood insurance, most of which is on the commercial side, but certainly the residential side shares a portion of that as well. There's a ton of capacity within the private market, and there is a ton of capital in the space ready to deploy. I'm sure you all know, but many states have approved forms and rates for admitted private flood options, which is a really great option for people who are concerned about the solvency of a carrier. Also gives people a place to go if they're dissatisfied with a claims payout. They can appeal that at the state level. The private market also offers significantly broader coverages than the NFIP. So in today's private market, we can pick up coverage for pools and landscaping and basements, loss of use, loss of income for commercial risks. There's just a ton of options right now in the private space for people. And finally, probably my favorite part about what's happening in the flood insurance industry right now, there's been a lot of innovation within the private market flood space, even in the last 5 years. The use and implementation of AI and newer technologies has really brought down barriers for us to be able to quote policies, issue coverages, bind coverages, service them, file claims. Those new technologies have done wonders in sort of making that a significantly easier process for us. Used to be, it was cumbersome and difficult to quote, and unless somebody was specifically asking you to do it, you likely weren't offering a flood quote. But with these new technologies, we can do it in a matter of seconds in many, many cases. And I know AI is sort of a buzzy term, and people are leery of it, as am I, and I think there's reason to be, but I also think there's a great opportunity here to leverage some of that to improve what we're doing. And then finally, parametric policies. This is a relatively new development as well, something we mostly see on the commercial side, not a whole lot of utilization on the residential side. I hope it trickles down to the residential side and gains some teeth in the commercial market, but that's a single payout policy where once a parameter is triggered, a lump sum payout is direct deposited to the insured's account within 24 hours, zero requirement to adjust the claim or file receipts. So it's a really great option for municipalities, large-scale manufacturing, things like that. Post-Hurricane Helene, this was a difficult hurricane season for us in the insurance industry this year. The day after hurricane, I'm physically located in North Carolina, so the day after Helene hit, I probably fielded 60 plus phone calls from very, very desperate people, only about half of which were even my insureds. The other half had just heard I was the flood person and were just desperate for a solution. Like I mentioned, $75 billion in direct losses. Helene was among the 15 most costliest natural disasters globally since 1900. And what I find super interesting about Helene is that while it was a 1,000-year flooding event, it was not the only 1,000-year flooding event we saw in North Carolina that year. 2 weeks before Tropical Cyclone 8 hit the eastern portion of North Carolina, hit a relatively small geographic area, but caused over $100 million in flood damages and was not even a named event. So that's pretty wild when you talk about the severity and intensity and frequency of these weather-related losses occurring. 2,000-year flooding events within 2 weeks in the same states, pretty substantial. Incidentally, most of my insureds with Tropical Cyclone 8 were calling me saying, the water didn't even get close during Hurricane Florence, so we thought we were fine. And these were people that had 4 feet of water in their homes. With Hurricane Helene, I had an insured with 22 feet of water in their structure. This was actually my only insurance policy I wrote in Western North Carolina. So of all those phone calls that I took, I had one policy in force. And for most of those insureds, a policy for less than $500 a year would have gone a long way in making them whole again. Before the storm, we were seeing premiums as low as $185 in Western North Carolina.
Thank you, Ms. Sutton. Eric, would you like to go next, please?
Sure. Eric Fossmeyer. I'm Chief of Staff and General Counsel for the South Carolina Office of Resilience. As y'all are well aware, the insurance crisis as it relates to disasters is really a risk crisis. So let me tell you a little bit about how we deal with risk at the Office of Resilience. We were born, this is our mission statement. I'm not going to read slides to you. I have quite a few slides, and most of them are meant for reference, so I'll move through these fairly quickly. But we do 3 things. We have a statewide resilience and risk reduction planning mission. We deploy the disaster recovery program for housing for the CDBG-DR grants that come to South Carolina. And we also deploy hazard mitigation projects with a number of different funding resources that have come into the state. So we actually implement projects. We do the strategic planning for risk reduction in SC. Our history was really born out of the 3 disasters that we had between 2015 and 2018. We had the 2015 historic flood. Our office was stood up as the disaster recovery office to deploy the housing recovery. We then had Hurricane Matthew in 16, and then Hurricane Florence in 18, and then, as you're well aware, most recently Hurricane Helene in 24. As a result of that series of disasters, Governor established a floodwater commission. One of the recommendations of the floodwater commission was to make us a permanent office as the Office of Resilience, and that's how we got started in 2020. In setting up our office, we were identified as the Office of Resilience, but the legislature didn't define what resilience meant, which allowed us to apply our own definition, and this is it. It's the ability of communities to anticipate, absorb, recover, and thrive when we're faced with disastrous impacts. I'd encourage you all to take a look at our website. This is our resilience plan. It's a data-based approach, a very collaborative approach that we took to identifying the risks that we face in South Carolina from a range of natural disasters, primarily flooding. So we used the highest quality data we had available. There was a high degree of coordination. We're looking at both natural systems and then also what happens in communities, not so much from a social standpoint, but from a structural and infrastructure standpoint. And one of the key principles that we addressed, and you'll see it in a map in just a minute, is that this is not a boundary issue. We approach this on a watershed basis. Let me just go forward to, if you look at the map at the top left, that's South Carolina and North Carolina, and we drain much of central North Carolina. So in draining much of central North Carolina, we have to deal with all the water that comes through there. And to Dana's point, that Hurricane Helene, if it had been 30 miles more to the east, we would have faced the impacts of 6 feet of water in our cities that North Carolina was facing in Asheville and the rest of western North Carolina. The Eastern Continental Divide, most of the water fell on the western side of that, so all that water went through Tennessee and onto the Mississippi River. All of this water that falls on the eastern side of the Continental Divide comes down through South Carolina, and the vast majority of it exits in Georgetown, South Carolina. And if you'll see the very tip of our PD watershed, it actually starts up in Virginia. So this is not a South Carolina problem. This is a multi-jurisdictional problem. And we have deployed watershed coordinators in each of those identified watersheds to work with local governments so that we're not solving a problem with one local government and then creating a downstream problem for the other local government. Some places, to just master the obvious, you want to speed up water, and in other places you want to slow it down. Let me just go back real quick. We have identified in there all of the various planning conditions that we utilized. We looked at land cover, we looked at population. South Carolina is a net positive growth state from a population standpoint, although it's not growing evenly. Horry County, where Myrtle Beach is one of the fastest growing counties in the country. It's going to be net 250,000 people by 2030. That's a lot of homes. That's a lot of surfaces. The rolling map you see on the right is a screenshot of land that is being conserved in South Carolina in an effort to add some resilience in protecting watersheds. I just call your attention to the top left. Dana had used some data from First Street Foundation. We love their flood modeling. We used it in our risk reduction plan because it's way more accurate than the FEMA floodplains. That map is of downtown Columbia, South Carolina. The red and orange that you see in it, if you were to see it blown up more closely, is areas that actually flood in Columbia, and the purple and blue is the FEMA floodplain. Doesn't even come close to identifying all the flooding issues, and it doesn't accurately account for both either pluvial or fluvial flooding, and it's just not a good resource upon which to base your insurance decisions. The middle map is all the properties in South Carolina that are at risk in a 100-year flood event of having at least a foot of water in their homes if it's a concentrated event in their area. And it's over 300,000 structures. It is a high risk, and it's not just focused on the coast. It's a statewide issue. And again, you can see in the top middle map, that's the entire watershed that we're dealing with. Oh, that was the Columbia map. So there you go. That's it blown up. FEMA floodplains don't work for us. And so we use the First Street modeling, which is an excellent resource. The other thing we're working on is better land cover analysis, knowing what structures, how many Walmarts do you have, how many parking lots do you have that lead to all of this runoff. And with every neighborhood that goes up, it's just more rooftops. And we're not anti-growth. We are in favor of growth. It's just, let's grow smartly. Maybe not put the Walmart parking lot on the very best soil in the county, which can lead to infiltration. And it's just really simple decisions like that at the local level that can really add to that community's resilience. So that middle red blob of stuff, that's downtown Columbia. The top data set is what we have right now. We're paying a little over $1 million to NOAA, which irritates me because it's our federal dollars already have paid for this data. But nonetheless, a little over $1 million to data to get 1 meter resolution so that we know what the land cover looks like. And that'll all be public information for all of our data that we have is available for free to local governments. It's up on our website. We have a resilience atlas, so we're going to improve our land cover analysis for local governments. On the disaster recovery side, I'll cover this very quickly. We've deployed 3 disaster recoveries successfully with no findings from HUD, which we're very proud of. We have repaired or replaced over 3,459 homes through those disasters, and we've learned some hard lessons along the way, but we have really commoditized the building of the new homes so that we can move quickly and efficiently. And as we go forward, we're making the homes more resilient by adopting the IBHS fortified standard, particularly as to roofing and continuous load path for the critical structures in the housing. That was Helene for South Carolina. It was more than triple the impact of the prior 3 disasters combined. We had more people register for FEMA assistance. We've had more counties involved, and the unmet needs are just incredible. It's $1.7 billion in unmet housing needs in South Carolina as a result of Helene. And we received the whopping sum, and we are grateful for it, but $150 million from HUD for our CDBG DR recovery. So it's a pretty big delta between $1.7 billion and $150 million. And so a lot of folks who are hurting are going to go unserved. Won't read that to you. That just shows you the relative impact, and we do understand that Congress had a difficult position last year. The data, when they made their congressional allocation for the 23 and 24 disasters, it was not very well developed for all of Helene, particularly in South Carolina, and we came up very short. Compared to the prior disasters and the flood on the far left, the CDBG DR funding covered about 38% of the unmet needs. On the far right for Helene, it's 8% of the unmet needs. So what do we do about it? Let's make the housing better. Let's not put houses and people in the way of the disasters. Don't make mistakes of putting folks in known places where it's going to flood. It's really some basic things. Those are our funding for our mitigation projects. We're spread out statewide. We don't just subrecipient this out. We've got engineers and project managers, and we're actually running the projects. Pretty cool, 2 cool projects here in Charleston. We're actually doing an environmental remediation of the USS Yorktown because it still holds fuel in it from 1974 when we accepted it from the U.S. Navy. And that's before they had any of the EPA cleanup guidelines. So there's over 1 million gallons of contaminated liquids inside that beautiful ship, and we're cleaning it up as we speak. We got crews there working 7 days a week on a project that just started. It's a $28 million cleanup that started in January. We also have in the bottom, on that photo is the Earhart Tunnel project here in Charleston. That's in the medical district. The top left was really just a rainfall event in April in 2024, which made those streets impassable. Down below is the result of the completion of that project. It's a deep shaft tunnel that connects to a longer horizontal shaft below the Albemarle Marl, which is clay that we sit on here in Charleston. And just gravity fed, that entire project will drain about 1 million gallons a minute, every 3 minutes, when you have a major rain event. It takes care of much of the rain flooding that we have in the medical district, but not the rest of Charleston. And we deployed that project because there were just continuous flooding just down the street from here in the medical district. There's a pregnant lady had to be carried in the bucket of a front end loader to get into the hospital during a rain event because it was impassable, worse than what the before structure photo is up above there. So mitigation works. I'm sure you know there's a 13-to-1 return. From the legislative standpoint, the more y'all can encourage mitigation and fund mitigation, your dollars pay off. If you haven't seen it, the U.S. Chamber in last summer identified that it is a 13-to-1 return now. It used to be 7-to-1. They reanalyzed it, and it's now put at 13-to-1 in reduction of impact and savings. That's an evacuation route that in Highway 17 in Georgetown County reduced the flooding with larger outfalls and higher capacity piping. That's the Yorktown. Won't spend any more time on that. Flood frequency, to Dana's point she made a few minutes ago, if you're in a 500-year floodplain, you have a 6% chance of your home flooding during the term of a 30-year mortgage. Go down to a 10-year floodplain, and you have a 95% chance of your home flooding during a 30-year mortgage. Those aren't really good stats. So we need to build better. We're not saying don't live near water, but let's be practical about it. Don't put critical resources on the first floor of a building. Elevate the building. Charleston County, tired of dealing with flooding in areas, now will not issue a building permit for a slab-on-grade home, which is a wonderful start. That gives you at least, a foot or so of crawl space where water can go if you have flooding in your neighborhood. So simply eliminating slab-on-grade, and I get it, it has its purpose. It's cheaper construction than erecting a foundation, or installing a foundation, but it just puts you automatically at risk. I know you've seen this data. It's just you look at the last 2 years, 27 and 28, 50 plus billion-dollar disasters, 190 disaster declarations in the United States. It's not going to go away. And I say this because we're not climate hysterics. It's just the data is telling you what's going on, and we have to deal with what the data is telling us. And that's why our approach is data-based. We're not going to get into debate about the causes of why all of this is occurring, but it's occurring, and the trend is not good. In probably early 1970s, there were only about 5 flooding days of tidal flooding in Charleston in a year. In 2019, they had 89 flooding days. And it's clearly due to sea level rise and some subsidence that we're having in Charleston. Charleston is sinking, and we have to figure out why, and we have to figure out if there's anything that we can do about it. If it's because of groundwater withdrawal for water systems underneath Charleston, then maybe we can redirect where we draw the water from. So sometimes you can solve subsidence, sometimes you can't, because there are big pieces of geological movements that can't be solved by us right now. So again, to Dana's point, we saw in Debbie 3 out of 4 homes were outside of the flood zone. So we have to identify, we have to deal with those risks. Our strategic resilience and risk reduction plan has a number of practical things that can be done to start to address those risks. We can go on. That's the benefit, and happy to answer any questions at the conclusion.
Thank you very much. I appreciate both of you for your presentations. Are there any questions from the legislators? Representative Carter.
Thank you, Madam Chair. And this question is for Dana. I grew up in Asheville. Okay, I'm very familiar with the French Broad River. What I didn't expect to happen in my lifetime is the devastation that happened from Hurricane Helene. Many of my family members are still suffering behind the impact of that hurricane as I speak today. My question, I see this as an opportunity, but if you're familiar with Appalachia, we have a literacy problem and an economic problem there where traditional and historic ways of reaching people about insurance may not reach the ones who need it the most. So my question to you and anyone on the panel is, how can we convince people in historically non-traditional floodplain areas? Now, part of Asheville is a floodplain area, and Hendersonville and Horseshoe because of the French Broad River. But a lot of Asheville is elevated, as you know. How can we convince people who are socioeconomically disadvantaged that just a minimum amount of flood insurance could help prevent what we're seeing, the suffering we're seeing today?
That's a great question, and not one I have a great answer for, quite honestly. The part of the Risk Rating 2.0 legislation was aimed at trying to improve some of the outcomes for people that that were more negatively impacted by these flooding events. But I think it comes down to education, and I think unfortunately the federal lending regulations really play a role here. They really drive this narrative for people, and that's a really tough hurdle to overcome. Whether you're disadvantaged or not, that message is not getting to people in general. So as insurance agents, we are doing, at least within my agency, we do as much as we can to have this conversation. But if I had $1 for every time somebody told me I'm not in a flood zone or my lender doesn't require it, we could all retire. I mean, it's just a conversation I have daily. But as far as how we reach those that might be more vulnerable, I don't have a great answer for that. I really don't. Education's the only piece I can come up with.
I don't mean to monopolize the time. Representative Carter, in our DR program, disaster recovery program, when we spend 100% of our funding in low to moderate income communities because of the rural impacts that where those disasters occurred. And for folks that were in the floodplain, we paid for the first year of flood insurance thereafter. Doesn't solve it, but at least gets them started down the path and might at least protect them for a year. But when you have folks that are faced with that difficult choice of medicine, transportation, health care, or flood insurance, it's an easy decision, right? It's not going to be flood insurance. So there has to be some slight incentive, other than losing your assets, to help pay for that flood insurance, and that's why we pay for it for the first year in our DR program. So at least there was a flood insurance policy in place at the time. We thought it would be a prudent thing to do.
I do know too, there are some municipalities, we mentioned the parametric policies. I have heard, and I don't know who's done it or where it's been done, but some municipalities have considered purchasing parametric policies to help those in those types of situations. So they would get a lump sum payout, and because there's no requirement for how that lump sum is used, they can use that money to help those who need it most.
Thank you, Dana. We're gonna need to keep going. We've got a couple of other topics even to hit after this. But to your point on the parametric policies, I don't know how that doesn't exacerbate the same concept as FEMA. When it's government that's paying for it and you just have this assumption that they're gonna cover it, then why would you do it yourself, is kind of the perspective from the other end that I'm taking away from what it is that you're saying. Representative Grosso?
Thank you, Chair. My question is also for Dana. Vanessa Grossel here from Kentucky. We've experienced our fair share of flooding, particularly recently. You mentioned in your data how few people actually have flood insurance. And when I speak with my constituents, one of the main concerns is that there are these acts of God clauses where people feel like even if they have insurance, they won't get coverage. And so I wanted to hear kind of what you make of that and how can we truly protect our constituents.
Yeah, I hear that a lot too. Certainly there are exclusions in insurance policies, and there always will be. I think that comes down to a discussion about how we define flood insurance and what is considered a loss. I heard that a lot after Hurricane Helene. Would that have even been covered on most flood policies, since mudslides are excluded on a flood policy? So that's a problem for the insurance industry as a whole. I think people are very skeptical of the insurance industry, but most of what I see, most of what we experienced with Hurricane Helene would have been rectified with a flood policy in force. So I think that just comes back to the insurance industry doing a better job of explaining to people what they are getting and what they are not getting within their policies.
Thank you. Representative Balcom?
Thank you, Madam Chair. So I represent Henderson County, North Carolina, which was hit very hard during Helene. So I'm sure I had as many phone calls as you did. I will tell you, in North Carolina, we are looking at a state plan of flood insurance. Myself and Senator Moffitt, we've been to Washington many times advocating. The sad part is that FEMA is only paying $45,000 as a max payout for this disaster. That is not enough for many people to get their homes. One thing that I've heard from a lot of homeowners is they were told, one, they were not able to get a flood insurance policy because we lived in the mountains, and why would we sell you that? Which is, I understand, we have a lot of education to do, and this disaster has brought that about. My thought is I would love some examples, and we can always take this offside, of how we can do a better job of educating and getting more insurance agents to be able to educate their clients and what
Yeah.
we can do for that.
I would love to be a part of that conversation. I think that's why jobs like mine exist. Insurance agencies and companies are recognizing that this is kind of a niche line of business, and most insurance agents don't know it. Because I'm located in Wilmington, North Carolina, that's where this expertise is sort of developed. I wrote a lot of flood policies, and that's how this has kind of evolved. But you're 100% correct. Most insurance agents, and I'm really disappointed in my industry as a whole to hear that people were being told they couldn't get it. I think, you mentioned the limitations within FEMA. I think that's a great opportunity for the private market to respond. And I think we have a massive gap in needing to improve our messaging and help people to understand there's a massive risk out there that we're just pretending isn't there. And unfortunately finding out the hard way, using flood insurance as a reactive measure rather than a proactive tool.
Thank you.
Thank you very much. Last question, Representative Foley.
Thank you, Madam Chair. With the large number of claims that we're seeing across the country dealing with flood, at some point in time, when are we going to have that discussion about spreading the risk over all properties and maybe including flood as a peril in all homeowners or property policies to spread that risk over a larger number of policyholders? Thank you.
Amen. Yeah, I'd love for that to be the conversation. I don't think we'll ever get there until those federal lending regulations change. I think we'll be sitting here 10 years having this exact same conversation until those federal regulations are updated. The NFIP's already acknowledged that the use of the flood zones is inaccurate. The risk rating 2.0 did away with the use of flood zones. So they have gone to this methodology of using modeling data to rate for flood insurance. So your zone is not even a factor in your rate anymore. So intellectually, they understand that the flood zones weren't cutting it. But I think at this point, it's a matter of political will. Nobody wants to be the one to start requiring more people purchase a flood policy. But I think until that happens, as I was mentioning earlier, the objections in people's minds are almost insurmountable as an insurance agent. I am a trusted advisor to most of my clients, and no amount of showing them the data is enough to overcome, well, I'm not in a flood zone or my lender doesn't require it. So I think until some of that starts to change, until the NFIP is no longer the backstop for everything, I think it's going to be a long road.
Dana and Eric, thank you both for your presentations, and thank you for the questions. Next on our agenda is a discussion on potential federal tax initiatives and their impact on the insurance markets. With us here today is Doug Lathrop of the American Council of Life Insurers. Doug, please go ahead with your presentation.
Thank you, Madam Chair. This is going to be a little bit of a jarring segue coming from a very robust discussion of flood to a conversation about the upcoming congressional budget process. So
I just have to interrupt for a second. I'm listening to the questions. I'm listening to your answers. And in my mind, I'm like, and world peace. There's
Right.
a lot of really fantastic questions and some very difficult answers that we don't have. So anyway, thank you very much, and I look forward to your presentation.
thank you very much. Yeah, my name is Doug Lathrop. I'm with the American Council of Life Insurers. I am the head federal tax lobbyist for the association. I appreciate the opportunity to speak to you today about the upcoming congressional budget debate and give you my perspective on how the next few months may unfold regarding the big, beautiful tax bill and the potential implications for the insurance industry writ large. So a couple weeks ago, the House passed the Senate-crafted budget. That's a significant milestone because it unlocks what is known as the budget reconciliation process. The budget reconciliation process at the federal level is a set of procedures that simply allows the majority, if it stays unified, to essentially sideline the minority party and pass legislation quickly. It's created in the 1970s as a tool to rein in spending, but it has evolved over the last 40 years, 50 years to become this bludgeoning instrument that the majority uses to pass major policies. George W. Bush used it to pass his tax cuts in 2001 and 2003. President Obama used it to pass the ACA. President Trump used it to pass his first batch of tax cuts known as the TCJA, and President Biden used it to pass the Inflation Reduction Act. Those are all pieces of legislation that really had nothing to do with cutting the budget. They most likely created larger budget deficits and implemented policies. So that's where we are with the reconciliation process. So without delving into the nitty-gritty of how it works, the basic advantage of reconciliation is that it neutralizes all of the powers that the minority party has in the Senate, which is the real obstacle. So you cannot slow a budget reconciliation bill down using the filibuster. It is filibuster proof. It also has a timestamp to it, so it actually just moves along. There is nothing you can do to stop it if the metrics are met in terms of the votes. In an era of hyper-partisanship at the federal level, it's really the de facto method to pass big bills when one party controls all the levers of government at the federal level. So this year, President Trump and the Republican Congress are going to use it to pass perhaps the most sweeping bill in recent memory. So one that's going to enhance border security, expand energy production and exploration, increase defense spending, and most importantly, cut taxes. While the other policies that are championed by President Trump and the Republicans are worthy of conversation and noteworthy unto themselves, the tax bill is really the centerpiece of this piece of legislation that they're going to consider. Now, we don't know what's going to be in the tax bill necessarily, but the contours are pretty visible. So the first thing they're going to do is they're going to extend everything that expires at the end of the year that was part of the TCJA. That includes all of the individual tax measures. So an increased expanded standard deduction, all of the rates, some important small business measures, that all expires at the end of the year. So that is going to be a key component, if not the largest component of this bill. Next, you have President Trump's priorities, such as no taxes on tipped income, no taxes on Social Security income, no taxes on overtime perhaps, and a new deduction for loans on American-made cars. Those are things that the president talked about on the campaign trail. He has continued to talk about these tax ideas while in office. I don't know if all or maybe just only some are going to be included in this bill, but some will. There's no doubt about it. In addition to that, most likely they're going to expand the child tax credit. There is support to do that, both bipartisan, but there are enough Republicans that believe that that's an important measure that needs to be expanded, and enhanced expensing for business. Now, depending on how you do your math, the cost of extending TCJA and all these new provisions could run anywhere between $6 to $8 trillion over the next decade. Now, here's where it gets a little tricky. A large chunk of those costs are just extending the TCJA tax cuts, roughly $4.5 trillion. The Senate, to make things easier on itself, has essentially wished those costs away by saying extending current policy has no impact on the budget. That's a deviation from how they used to do it, where they would say, well, we have current law is how we're going to measure it. So they have decided to say current policy is the baseline we will use. So that takes $4.5 trillion off the table. Fiscal hawks are aghast, as you could imagine, and we'll see if the bond market believes this kind of magic wand. But for now, that solves a big political problem. Now, the other stuff may have to be offset, and that's where you're going to have either new revenue or much deeper spending cuts in order to accomplish this mission. And here is where the life insurance industry, and frankly, all insurance, might be at risk. So before I go there, I want to just go back in time briefly and talk about what informs the current posture of the life insurance industry. The 2017 tax bill was not like something we threw a parade over. The industry was actually targeted for roughly $25 billion worth of offsets, which were included in the bill to help drive the corporate rate down to 21%. One of the offsets was a substantial change in how life insurers are able to deduct for the reserves that they hold. Before 2017, life insurance companies could essentially deduct almost 100% for the reserves that they hold. These are obviously statutory requirements that all the states mandate that we hold. And what the federal government decided to do, or policymakers decided to do, is we're going to haircut that. And instead of allowing you to deduct roughly 99 cents on the dollar, now you can only deduct 92.7 cents. Now you might say to yourself, well, what's the big deal? That's not huge, it's roughly 7%. Well, it applied retroactively, so all the reserves that insurers hold, life insurers hold, which amounts to, I think, close to $1.8 trillion, you had a haircut applied to that. So that offset alone, and that is a permanent feature of the tax code, essentially wore away the benefit of the rate drop. So I just talk about that briefly to say that that's what informs the posture of the life insurance industry, because we were targeted. And it's sort of an editorial aside really quickly. You know, insurance is state regulated, and rightly so, and that is a good thing. But when you have federal problems, oftentimes they materialize because there's just a lack of familiarity with the business, and insurance oftentimes has to do twice as much education in terms of reaching lawmakers and explaining the business model and making sure you meet them where they are. And if you have gaps and if you have sort of misunderstandings, they can oftentimes turn into big problems. And certainly at the tax space with the two tax committees, we saw that in 2017. So the potential threat today actually is an unusual one, and again, something that's unique to insurance. There has been ongoing discussion at the federal level of eliminating or curtailing the deduction that companies can take for state and local taxes. It's called C-SALT or B-SALT. You might have heard about it in press. Where that would threaten insurance, and this is everything, health, property casualty, as well as life, is inclusion of premium taxes in that calculation. So we're talking, you know, not just income taxes. The debate as it's moving along in furtive ways, we're trying to figure out what they actually mean when they say they want to eliminate corporate SALT. If they did that and actually included premium taxes, we estimate that would result in essentially a 4 to 7 point rate hike at the federal level for carriers, because we pay a tremendous amount of premium taxes, and we will continue to pay premium taxes. That won't go away. It's a cost of doing business. It's a gross receipts tax at the state level. So when they decide, meaning the federal policymakers, if they decide to do that, it would have a massive impact on the federal tax burden for carriers. We're doing our level best working with the property and casualty trade associations to try to educate lawmakers as to why it's a bad idea, and again, a disproportionate sort of hit to the insurance industry, which most likely would result much later on, but would result in an inflationary impact. You know, if you're going to put that in motion, you can't reprice old business, at least at the life insurance level. And so that would end up being borne by new policymakers at some, or new policy holders at some later date. right? So we're trying to educate folks that this would have a really serious impact at a time where we're already struggling with inflation on a variety of levels. So the next few months are going to be a pretty anxious period for the life insurance industry. We have largely adopted a position when we talk to lawmakers of just leave us alone and let us do our job, trying to remind them of how we responded during COVID, our critical importance as a source of patient capital in the U.S. economy. You know, my colleague Leah mentioned the $3.8 trillion that we hold in high-grade corporate debt, and how we are essentially a shock absorber and in times of volatility. We provide financial security for 90 million American families at all stages of their life, and obviously we sell products that take away risk and provide a guarantee, which is a key component for middle-class economic stability. So that's what we're trying to just drive home. We're obviously taking nothing for granted. Hope isn't a strategy, and as Harry Truman said, you know, if you want a friend in Washington, D.C., go get a dog. So, you know, you need to operate as if everybody has, two faces in some respects, but we are working our level best to try to ensure that this doesn't transpire, and hopefully this is something that we can put to bed at the end of, say, this summer. Thank you for your time. I'm happy to answer any questions.
Thank you, Doug. Legislators, do you have any questions for? Go ahead, Senator.
Thank you, Madam Chair. This is a health insurance question. Do you have any crystal ball on the enhanced marketplace subsidies?
I don't, and I don't have any expertise in that area of the insurance space.
All right,
Sorry.
thank you.
We mandated you bring your crystal ball today. What happened?
I'm sorry. What?
That's-
Well,
It was a joke. Sorry, apparently a bad one. Are there any other questions? Seeing none. Thank you very much for your presentation. Appreciate your time. Next on our agenda is a discussion on federal health care proposals and their impact on the state system. With us here today is Bailey Rivas of Families USA and Michael Cannon of the Cato Institute. We'll hold questions until both are finished. Bailey, why don't you go ahead and start?
Hi, thank you so much. I will try and move through this expeditiously, but there is a lot going on in healthcare, and I will get to the APTC question that you had raised. Hi everyone, my name is Bailey. I'm a senior manager of government relations at Families USA, which is a leading national nonpartisan voice for healthcare consumers that for more than 40 years has been working to achieve a vision of a nation where the best health and healthcare are equally accessible and affordable for all. Today, I'm going to talk about what healthcare changes or reforms are likely this year at the federal level, including changes around Medicare, Medicaid, private insurance, as well as some potential additional reforms. So before diving into the specific policies, wanted to quickly set the scene just about where we are with health coverage right now in America. We know that more people are covered than ever before. Since 2010, we've seen the amount of folks without insurance drop pretty dramatically, almost in half, from 49 to 26 million. And year over year, we see that the ACA marketplaces continue to reach record enrollment this most recent year with 24.3 million. However, simultaneously, we see that families are still really grappling with the cost of healthcare, that healthcare bills still just are really out of reach and leading to significant medical debt for families. We see out-of-pocket costs skyrocket and know that high drug costs and hospital bills are significant drivers of those costs. Additionally, it's not just the cost at the pharmacy or the hospital bill that are creating issues, but we're seeing year-over-year increases in premiums and deductibles, which is negative in and of itself, but we also know that these costs overall have a downward pressure on wages as well. So we can see that the cost of healthcare is also driving down families' wages. So all taken together, we know that getting insurance is still the best way to reduce your health costs, and being in insurance, people are still paying significantly less than they're uninsured, so it's critical to protect these gains that we've made, but that there's also a lot of opportunity and reforms that need to be made for folks that are insurance to really bring down the cost of care. So, wanted to start first with Medicaid, given it has significant impact on states. Thank you so much to Doug for starting off with the reconciliation process and kind of giving a teaser on that. We anticipate most of the changes this year being made through Congress, through this reconciliation process. As Doug mentioned, there's a significant amount of tax cuts that Congress will be trying to move, and they can either increase revenue or they can significantly decrease spending, and we see Medicaid as a pretty significant area that they will plan to decrease spending. So particularly true on the House side, where the House Energy and Commerce Committee, which is the lead committee with healthcare jurisdiction, is likely to be, they're requiring themselves based on this framework that they've created to cut $880 billion over 10 years. Again, that's a floor. They could cut more than $880 billion. That will be necessary if they end up moving any provisions forward that cost money. But at minimum, they have to cut $880 billion. So as you can see from the chart that I included on the right, given that Republicans have pledged to not make any changes to the Medicare program, based on the jurisdiction of the committee, they can really only get that number by making really significant changes to the Medicaid program. There are a number of proposals that we know Congress is considering that I just quickly want to touch on. The first being implementation of work reporting requirements. This is essentially just increasing the additional paperwork and bureaucracy that folks who are enrolled in Medicaid have to go through to prove that they are either working or seeking work while enrolled in Medicaid. This is despite the fact that 92% of the people who currently use Medicaid are working and or students, and those who are not are often disabled, ill, or caregivers themselves. The next reform that I'm sure the folks in this room are already more familiar with than I am would be elimination or reduction in state provider taxes. These are taxes that states levy on healthcare providers or entities, often including hospitals, nursing facilities, and managed care plans. All states except for Alaska finance some of their costs through these taxes, and approximately 17% of state Medicaid dollars are comprised of provider taxes on average. So without these taxes, states would have to cut the Medicaid spending by either lowering their payment rates to providers, cutting optional Medicaid services. This includes things like adult oral health coverage in Medicaid, or reducing program eligibility. The third potential change is reducing the federal share of Medicaid funding through the FMAP percentage. So this is also includes fully eliminating the FMAP bonus that states who have expanded Medicaid are getting. And this is not only deeply concerning for state budgets, but for at least 12 states, they currently have trigger laws in place. So if you lower the FMAP percentage below a certain amount, those states automatically end their Medicaid expansion programs. So it would be concerning for the budget, but it also means likely that overnight you'll see millions of people losing their Medicaid coverage. And then finally, fourth would be eliminating some existing rules that were put in place under the last administration that essentially make the eligibility determination process less burdensome. Without this streamlined rule, we see that it's likely families are who are eligible for Medicaid are unlikely to stay enrolled just because they have to go through additional paperwork and process. And then finally, it would be fundamentally restructuring the Medicaid program into block grants or per capita caps, which would mean states get a certain amount of money each year regardless of how many people are enrolled, or how much money Medicaid is costing the state that year. So there are a lot here. As Doug mentioned, we'll get more details to come. We expect that the Energy and Commerce Committee around May 7th will be putting forward the details of what they're planning to include, but I just want to especially highlight that really of any of these reforms, it's completely clear that they would have significant impact both on state budgets and also likely lead to millions of families losing affordable health coverage. I'll also just add, unless they go down a path of block grants or per capita caps, it's likely that they will have to combine multiple of these provisions with work reporting requirements, which we think are especially likely. That alone won't hit that $880 billion that they'll need to meet, so they'll likely be looking at many of these provisions at once. Okay, so that's the Medicaid of it all. All right, to private coverage, so starting off with your question about APTCs, we know that the tax credit, often called enhanced premium tax credits or APTCs, they are expiring at the end of this year. Those tax credits are relied on by millions of families to help reduce the monthly costs through the ACA marketplaces. As you can see from this chart, I put up just the difference in what many families will be paying should these tax cuts expire. For many families, we will see their monthly premium costs double. We know that there is bipartisan interest in Congress to address these. However, we just haven't seen any action yet. And this is a pretty concerning ticking clock as, again, they expire at the end of the year. And I know many states are already putting forward work to announce your premium rates, and the certainty of knowing these tax credits are there is a significant part of that process. Additionally, some other reforms that we think are possible from Congress, based on what we've seen from previous Congresses, is around association health plans or short-term plans. I'll just note from our perspective, these plans often allow insurers to skirt requirements for comprehensive coverage. So people who are enrolled in them are not as likely to get the affordable coverage that they need when they go to the doctor. I'll also note that with short-term plans, because they essentially allow plans to opt out of a lot of the essential health benefit requirements of the ACA, that it also means that they are not necessarily held to state requirements for things like essential health benefits, so it also undermines state authority over some insurance plans. Finally, we know that Congress is likely to consider reforms about expanding the use of health savings accounts. And I'll just note that expanding of HSAs often incentivize more high deductible plans and often lead to plans with smaller employer contribution because they're higher deductible, making monthly and annual costs for families more expensive. And then just quickly touching on a few administrative priorities around private coverage, there was a rule that was actually recently proposed by the new administration on the ACA marketplace that had a couple of key pieces I just want to lift up. The first is mandating shorter enrollment periods. This is even true for states that operate their own ACA marketplaces. They will be required to follow the new enrollment dates, which I believe is November 1st through December 15th. They cannot have a longer one, which I know many states have utilized to help get more people enrolled. That rule also included language that essentially limits states' abilities to add additional coverages based on their population, your constituents. That includes specifically coverages for DACA individuals as well as gender-affirming care. So it's limiting states' abilities to control, the healthcare that they think is best for their constituents. We also know that the federal, from the administrative perspective, there have been significant reductions in funding for the Navigator program, which is key to helping families who are enrolling in the federal marketplace, navigate through ACA and Medicaid enrollment. And then finally, we also know that there's some risks to changes in coverage for the preventative health services. These are essentially the required preventive services at no cost that insurers have to give through the ACA. There's a pending Supreme Court case, Braidwood v. Kennedy, that could potentially limit or entirely threaten that program as well. Looking at Medicare, there's not a lot of expected reforms, candidly. Both the president and many elected officials throughout their campaigns made promises not to make major reforms to Medicare, so at this time we don't anticipate anything significant, but just wanted to quickly highlight that the Medicare negotiation program, which was recently implemented through the Inflation Reduction Act, has gone into place. The first round of 10 drugs that have been negotiated, those costs go into place in 2026, and the second round of 15 drugs, that negotiation process has begun, and we don't anticipate that the change in administration will have any impact on that process. So we'll just be continuing to ensure robust negotiation to lower costs, both for folks at the pharmacy counter as well as for the Medicare program itself. And then also just wanted to note that there's been an uptick in bipartisan interest around addressing some abuses occurring in the Medicare Advantage program. We've specifically seen a rise in conversation around addressing overpayments and coding abuses that Medicare Advantage plans have been charging the Medicare program. For those that are unfamiliar, these Medicare payments often cost the Medicare program billions of dollars every year. And we saw bipartisan interest in Congress with reintroduction of legislation, as well as questions from both sides of the aisle around this issue during now Administrator Oz's confirmation hearing. And he also remarked during that confirmation hearing that he was eager to take action on this issue. Additionally, wanted to also just highlight that we anticipate potential action around transparency. In MA, this is especially true over things like prior authorization and supplemental benefits, and just really getting an idea of, what are the benefits and ensuring that seniors in MA are really getting the care and quality of care that they're paying for. Okay, so that's all the coverage pieces. There's a lot on this slide. I'm not going to go through all of it, but I did just kind of want to touch on some themes. These are things that are really.
You need to speed it up. We've got one more person on this topic, and then another topic.
Okay, this is my last slide.
Okay.
So this is issues to kind of address those like underlying drivers of what's making healthcare costs so high. We know that there's been a lot of bipartisan interest on many of these reforms, and actually several of them almost passed at the end of the last Congress, and unfortunately just didn't, due to nothing related to these provisions, but some general larger dynamics at play there around the federal appropriations process. So just like quickly bucketing them, the first is through increased transparency, just getting a better understanding of what rates folks are actually paying at hospitals or PBMs are negotiating, as well as getting an understanding of what hospitals are paying at outpatient versus inpatient settings. The second is same service, same price policy. So this is just ensuring that if you have a doctor's office that gets bought by a large hospital chain, that they are not suddenly charging additional or unnecessary fees. And then finally, and I'll just end on this, this is really the piece that we think is most important to what is driving healthcare costs right now, which is these anti-competitive behaviors that we're seeing across the healthcare industry, either from hospitals consolidating into state-driven chains or insurers vertically integrating with PBMs and pharmacies, or to drug companies, using the patent system to keep generic competition from entering the market. This is really what is underpinning so much of what's driving costs. And so just getting an understanding of how this consolidation is happening and taking action to really crack down on this consolidation, we believe is extremely key to addressing these high costs. So thank you so much. Sorry.
Thank you so much. Warp speed. Everybody get all that?
Happy to talk after.
Michael?
Hi, Michael Cannon, Director of Health Policy Studies at the Cato Institute. First time speaking at NCOIL. Thank you for having me. I want to say a little bit about what's going on at the federal level, what states need to know about what's going on at the federal level, and then give states a little bit of hope and an idea for how they can themselves make access to care better and more affordable and more secure, and which is what we all want, even if we have different perspectives on how to achieve it. State perspective on the federal level. The federal government needs to cut health spending, and it needs to cut health spending dramatically in the near term, because if it doesn't, the federal government is going to hit a brick wall. It's going to hit a debt crisis, and when that happens, it'll make any sort of cuts that you may be imagining Congress might be contemplating right now seem like child's play. Just a brief word on that. The $880 billion that the House has said that the Energy and Commerce Committee has to take out of its jurisdiction, which is probably Medicaid, if they took all $880 billion out of the Medicaid program, that means that federal Medicaid spending, which under current law would grow at 4.5% per year over the next 10 years, would instead grow at 3% per year. That's not a cut. This is hysterical, nonsensical, pearl-clutching propaganda by ideologues and an inefficient healthcare industry that wants to keep their sweet, sweet federal subsidies and keep providing people high-cost, low-quality care. If we don't restrain federal spending far more than what Congress is contemplating right now, then you are going to see work requirements for health care that are far beyond any sort of work requirements they're talking about right now. In other words, you don't work, you won't get any health care at all, because you're going to have the federal government dramatically cutting Medicaid, because that's where they go first to make cuts. Poor people don't vote like seniors do. That's why Medicaid is on the chopping block, not Medicare. And then states are going to have to state legislators are going to take the blame when that federal money disappears, and states have to decide, okay, do I raise taxes on my constituents in order to keep these programs, to keep the payment levels and the enrollment and the benefits levels as high as they are, or am I going to have to cut? So unless Congress gets its act together and does much more dramatic cuts than what they're contemplating right now, which aren't even cuts, then then we're going to be in an awful, awful place. The federal debt is 100% of GDP right now. Congress is adding another 6% of GDP every year. The main driver of that is federal health spending. Federal health spending is the largest category of federal spending, larger than the debt service, larger than Social Security, larger than the Defense Department. And it is it's the only category of federal spending that is growing faster than GDP. So that is the main driver of this debt crisis. Congress has to cut that. Now, you might think, well, this is going to, those sorts of cuts would jeopardize access to care for people, would jeopardize the quality of care that people receive. Well, you know, I would love to be able to tell you that the Medicare program and the Medicaid program do what its fans say and provide high quality, low cost care to enrollees. But these are wildly expensive programs that reduce the quality of care in this country. For example, the Medicare program, relative to other countries, is the most expensive part of the U.S. health sector, which is the most expensive in the world. So I could do a little more doom and gloom. I could do a lot more doom and gloom, in fact. There's a lot of dispelling that needs to happen. But let me give states a little bit of hope about what they can do in a positive direction that would make healthcare better and more affordable and more secure. And to do that, I wanted to make a little detour to the German Democratic Republic. In the GDR, there is a compulsory system of health insurance where employers make payments into the system on behalf of their workers. It's really the workers' money, just like it is in the United States, but we pretend it's the employers. And Germany allows, alongside of that compulsory, very rigid government program, a relatively free market for health insurance, where people can buy lifelong insurance plans. Insurers can underwrite, which allows them to provide that sort of lifelong coverage, where your premiums, where you don't lose your coverage if you get sick, your premiums don't go up if you get sick, and you can renew year after year. That aligns the incentives between the insurer and the insured, so that the insurers behave better. And to the extent that this market keeps, now you might think, well, if Germany allows that sort of market to exist alongside the compulsory system, won't all the healthy people go into that market? If you take a static one-year view, maybe. But when you take a longer-term view, the picture changes, because those people who go into the relatively free market, individual market for healthcare, for health insurance, once they become sick, they don't want to leave their plans and go back into the compulsory system. They want to keep that guaranteed renewability protection. They want to keep the low premiums and the better access to care that those plans afford than, say, the compulsory German system does. And so, to the extent you're keeping sick people out of the government program, that reduces the burden of that program on taxpayers. Not only can we do the same thing in the United States, which would align the incentives of insurers with consumers, provide higher quality coverage than Obamacare does. I'd be happy to talk about why that is, and do so at a much lower cost, because the premiums for insurance plans, once you strip out all of the Obamacare regulations, can be 60–70% lower for most consumers. But states can enact those reforms by themselves. I had brought some handouts. I hope they've made their way to you. If not, they'll make their way to you before you leave today, or we can email them to you, that explain that in 2014, the Obama administration sort of gave a gift to states. It gave a gift to states indirectly by directly giving a gift to U.S. territories. It said to U.S. territories, hey, the administration said to U.S. territories, hey, look, we know that we are imposing all these regulations on you, or the ACA creates all of these regulations that would destroy your health insurance markets. We're going to exempt you from those regulations. The Obama administration did it by regulatory guidance or a memo. So community rating price controls, essential health benefits, medical loss ratios, single risk pool, guaranteed issue, and one other, 6 of them, I always forget one. All of the most expensive regulations in Obamacare don't apply in U.S. territories. Now, what does that have to do with states and how you can make health insurance more affordable and more secure? Every state in the union has the power to remove barriers to entry into their health insurance markets for plans that U.S. territories license. At least one of those territories has much more liberal, permissive, deregulatory rules when it comes to health insurance pricing than Obamacare requires, the U.S. Virgin Islands. And if your state authorized for sale in your state any health insurance plan available in any U.S. territory, then plans from the U.S. Virgin Islands could be available to all the employers and individuals in your state. Many of them could save 50, 60, 70% on their health insurance. They could buy guaranteed renewable lifelong policies that would stay with them between job changes and that would not create the perverse race to the bottom incentives that Obamacare's community rating price controls create. You would also allow for more innovations like the type that United Healthcare introduced in 25 different states in 2009 that fill the gaps in employer-sponsored insurance by offering a very low-cost product to people that says to them, when you leave your employer plan, you can enroll in one of our plans, no matter how sick you got in the meantime, and you'll still pay healthy person premiums. There are all sorts of things all sorts of ways that competition in health insurance markets can make health insurance more secure. And one of the handouts that I provided was model legislation that Florida legislators introduced along these lines that would allow their residents to purchase any health insurance plan available in any U.S. territory. They're available, you have major insurance companies like United Healthcare, Humana, Aetna, Cigna that do business in the territories that already have networks in your states. And you don't need Washington's permission in order to do this. I've heard from at least one large insurer that if this happened, they would definitely take advantage of that. And this is something that you can do to protect your state in case there are major cuts in federal health spending, forcing you to cut people loose from the Medicaid program, such as in the Medicaid expansion population, because those are the people for whom we need to get the premiums down the most. Those are the people living at the margins and scraping by and struggling to afford health insurance. Obamacare is so expensive that Congress is offering subsidies of $12,000 to people making $200,000 a year. That is not affordable coverage. We need to make coverage more affordable, and it's within your power to do it. Thank you.
Thank you, Michael. I appreciate your presentation, both of your presentations, very much. I did not have "let's do it the German way" on my bingo card this morning as a recommendation, but thank you very much. I appreciate it. Colleagues, I'm going to ask you to seek them after the meeting if you have questions for them, because we are running up against our deadline. Thank you both very much. Last on our agenda is the introduction and discussion of the Incoil Health Savings Account Federal Regulatory Coordination Model Act. That's easy to speak. Thank you. You can view the model in your binders, page 133, and on the website and app as well. Before we go any further, I'll recognize Utah Representative Incoil's Secretary, Jim Dunningham, who is sponsoring the model. Please go ahead.
Thank you, Madam Chair. I am very pleased to sponsor this model. In 2023, Incoil passed a resolution in support of embedded provisions in state insurance codes to protect health savings accounts and qualified health insurance policies from certain state benefit mandates. What that resolution did in the simplest terms is encourage an amendment to state law to help ensure that when states adopt certain types of laws, they don't inadvertently cause people to lose access to their health savings accounts. Since then, in the last couple of years, we've seen this issue continue to pop up in state legislatures. So I think now is a good time to go a step further and craft a model law that we can provide to states that want to look to implement this type of policy. My home state of Utah is one of several states that have addressed this issue, and I think other states would benefit from looking at the model to help them through this process. I look forward to working with the committee this year and consider the model later in the year. Thank you, Madam Chair.
Thank you very much. On reading on this, I got pretty excited about what was being offered. So my husband's a tax attorney, CPA, and when I told him about it, he got excited too. So we are both nerds. It's official. We'll now hear from Kevin McKinney of the Health Savings Account Council. Did I pronounce that right?
McKechnie, but it's good to see you.
It's good to
I
see
work
you.
for the American Bankers Association, and my portfolio includes everything discussed here, and I find myself in the unusual position of doing something I think non-controversial. And more to the point, I brought a graph, which you have. In the interest of time, I understand there's a reception after this. We can fill hours on this question, but it goes something like this. States control what is in a health insurance contract. However, the federal government has decided what a high deductible health plan is, and states have no role in that process. And so this is a coordination amendment. You might think of it as a technical correction in some ways, meaning whatever is in your health code and whatever you decide to put in your health insurance plan is up to you, not me, and it's not up to the federal government. what a high deductible health plan is up to Congress. And so what we're trying to encourage you to do is to adapt the kind of stuff that's in Oklahoma. Thank you, Representative Hefner. In Utah, thank you, Representative Dunnigan. And a gentleman who is not here, Senator Jerry Klein from North Dakota. All those states have done what the representative suggested so that you can't inadvertently disqualify people from their contribution eligibility to their health savings account. And it's astonishingly easy to do, because all you have to do is say, well, you know what, we think there should be no cost sharing on, and it only has to be something that's not on the U.S. preventive care list, which already allows no cost sharing for something like that. And so this is, we think, a consumer-friendly amendment. We think something that keeps people on the kind of health insurance they picked. And of course, it's not a marketing triumph to call something the high deductible health plan, but that was 21 years ago, so we ask forgiveness for this question. We would call it HSA qualified plans now if we had to do it all over again, and that would feel much more palatable, I think, to you. But that's the long and the short of it. There can be longer, but we're out of time, and so in the interest of time, unless there are questions, I'm happy to conclude, and thank you for entertaining my comments.
Thank you. Are there any quick questions? We will be bringing this up over the summer. Okay, thank you, everybody.
Thank you.
Before we adjourn, a couple of quick pieces of business to attend to. Louisiana Senator Kirk Talbot, who unfortunately had to change plans last minute and wasn't able to make it down to Charleston, has offered up a draft letter from state legislators to Congress. You can find that letter on the app or website or in your binders on page 136. This letter expresses concerns with FEMA's rising risk rating 2.0 program, urges Congress to take action on the program and reform the NFIP. If you have any questions, please reach out to Senator Talbot or INCOIL staff. And lastly, I'd like to recognize Kevin, pronounce it for me one more time.
McKechnie.
McKechnie.
Yes.
Kevin McKechnie, again.
For a quick update on DSAs, you're going to
Yes.
enjoy this. It is spreading like wildfire in the States. And the reason it's spreading like wildfire is because as we reach for solutions to all the problems you heard today, it's become apparent that, and if you haven't seen the graphs that Devenir Research in Senator Yuki's state produces in Minnesota, Devenir Research, what you want is what we have in health savings accounts, meaning you've got tens of millions of people storing hundreds of billions of dollars, well, not yet, $180 billion for things that haven't happened yet. And that's not true in homeowners insurance. And so it will take time, but over time, legislators and states have recognized the importance of having people prepare themselves. It addresses your question about education. And that means that over time, people will have the ability to buy insurance that perhaps has higher deductibles, helping the insurers recapitalize, that gives them an incentive in their own property maintenance, to your point about flood insurance. They might be able to buy new base flood elevation certificates, buy foundation vents, things like that on a tax advantage basis. We want to encourage all of that. And the states that have done the best job on that are waiting, and they're very interesting. California, there's already something in Iowa, something in Utah, something in Oklahoma. We're watching New York. And they already exist in this state. They exist in Mississippi and Alabama. And we're hoping there's going to be a federal solution soon. It has a long history. We can go into it, but again, time is of the essence. But the long and the short there is that former and unfortunately late Senator Inhofe asked for this idea 11 years ago. And it's taken some time to matriculate, but we're finally at that spot where crisis equals pragmatism. And we think we'll get somewhere this time. Questions?
If I remember correctly, reading the minutes, you were looking at a friendly amendment that would allow it to pass through family members in the event of the account owner's death. And I think that's some pretty good advice that we need to discuss also over the summer. Thank you, Kevin. Appreciate that very much. Ladies, there's a women's caucus event in the Pinckney Room on this floor right after this meeting. Gentlemen, I'm sorry, you don't get to come. And hearing no further business, is there a motion to adjourn? There's a motion and a second. All in favor? We are adjourned.